Hello everyone, this is Doc from the Wealth Boardroom. Welcome to the channel. Today we're setting sail on a journey through the fascinating world of 1031 exchanges. It's a strategy that's been a game changer for many real estate investors, helping them build and protect generational wealth. We'll be breaking down what it is, how it works, and the steps you need to take to make it work for you. So buckle up as we dive deep into the world of 1031 exchanges. The first question that might come to mind is, what exactly is a 1031 exchange? It's a term that might sound complicated, but it's actually quite simple. Named after Section 1031 of the United States Internal Revenue Code, a 1031 exchange allows an investor to defer paying capital gains, taxes on an investment property when it is sold, as long as another like-kind property is purchased, with the profit gained from the sale of the first property. This mechanism is a powerful tool for building and protecting generational wealth. Imagine this. You have a property that has appreciated in value over the years, and now you want to sell it. Normally, you'd have to pay hefty capital gains taxes on the profit you made, but with a 1031 exchange, you can reinvest those profits into a new property and defer the taxes. This allows your investment to continue growing, tax deferred, creating a snowball effect that can significantly increase your wealth over time. But how does it work? It's a process governed by specific rules. To start, the properties involved must be of like kind, meaning they must be similar in nature or character, irrespective of differences in grade or quality. This gives investors a lot of flexibility. For example, you could exchange an apartment building for a strip mall, or a piece of undeveloped land for a rental property. Next, the investor cannot receive the proceeds from the sale of the first property. Instead, these funds are held by a third party, known as a qualified intermediary, until they are used to purchase the replacement property. This ensures that the investor never actually takes possession of the funds, which is key to deferring the capital gains tax. Finally, there are strict timelines that must be adhered to. The investor has 45 days from the sale of the first property to identify potential replacement properties, and 180 days to close on the purchase of the replacement property. Now that we know what a 1031 exchange is, let's move on to how to actually do one. Doing a 1031 exchange might seem complicated, but it can be broken down into 5 basic steps. First up, choose a qualified intermediary. This is a professional who will coordinate the exchange. They could be a real estate agent, an investment professional, an employee, an attorney, or a certified public accountant. However, it's important to remember that you cannot act as your own intermediary, nor can you choose someone who's related to you or who has acted as your agent in the past 2 years. Next, sell your current real estate property. This is the property that you're looking to replace in the exchange. Make sure to sell it at a price that will allow you to purchase a replacement property of equal or greater value. Now comes the tricky part. You have 45 days to identify potential replacement properties. This is known as the identification period. You can identify up to 3 properties without regard to their fair market value, or more properties if the total fair market value does not exceed 200% of the total fair market value of all the relinquished properties. Once you've identified your potential properties, you have 180 days to close on a replacement property. This is your exchange period, and it begins on the date you transfer the relinquished property. Remember, the replacement property must be of equal or greater value than the one you're selling. Finally, file IRS Form 8824. This form reports the exchange to the IRS and must be filed in the year in which the exchange begins. You'll need to provide details of the properties involved in the exchange, the dates of transfer, and the fair market values. And that's how a 1031 exchange is done. Now, let's talk about choosing a replacement property. Choosing a replacement property is a crucial step in a 1031 exchange. It's like picking a dance partner for the next big waltz. You want to make sure you're both in rhythm and can glide smoothly across the floor. Now here's the beauty of a 1031 exchange. Your replacement property doesn't necessarily need to be the same type as the one you're selling. You can trade in an apartment complex for a strip mall, a vacant land for a rental property, or even a warehouse for an office building. Talk about freedom of choice, right? But wait, there's more. Your replacement property can be located anywhere in the U.S. It's like having the entire country as your real estate playground. So whether you're eyeing a beachfront property in Florida or a commercial space in the hustle and bustle of New York City, the choice is all yours. Now, if you're thinking, but what if I want more than one property? Well, you're in luck. An exchange can include multiple properties. It's like going to a buffet and being able to pick and choose exactly what you want. But remember, the total value of the replacement property or properties must be of equal or greater value than the one being sold. It's a bit like upgrading your phone. You wouldn't trade in your latest model for an older one, would you? The same principle applies here. One more thing to keep in mind. There's a clock ticking. You have 180 days to close on a replacement property. That's just about 6 months, which might seem like a lot of time, but in the world of real estate, it can pass in the blink of an eye. So, make sure you're decisive, but also diligent in your selection process. With these guidelines in mind, choosing a replacement property should be a breeze. Now, let's move on to the role of a qualified intermediary. This person or entity will be your partner in this financial dance, ensuring you follow all the right steps and meet the necessary deadlines. But that's a topic for the next scene. A key player in a 1031 exchange is the qualified intermediary. This role is pivotal to ensure the exchange complies with IRS rules. So, what exactly is a qualified intermediary? Well, in a nutshell, they're the entity that facilitates the 1031 exchange process, holding the funds from the sale of the relinquished property and later using them to acquire the replacement property. Now, who can be a qualified intermediary? Almost anyone, really, as long as they're not related to you or haven't acted as your agent in the past 2 years. So, no, you cannot be your own intermediary. There are also certain professionals who often act as qualified intermediaries due to their familiarity with the process. This includes real estate agents, investment professionals, attorneys, and certified public accountants or CPAs. These individuals bring their expertise to the table, making the exchange process easier and more efficient. However, it's important to remember that while these professionals may be well equipped for the job, not all are created equal. Some may have more experience or a better track record than others. Therefore, when selecting your qualified intermediary, it's crucial to do your homework. Look for someone with a solid reputation, extensive experience, and a thorough understanding of the 1031 exchange process. Choosing the right qualified intermediary can make your 1031 exchange process smoother. They're the guiding force that helps you navigate the complexities of the exchange, ensuring your investment journey is as seamless and profitable as possible. So there you have it, a comprehensive guide to 1031 exchanges. We've taken you through the journey of understanding what a 1031 exchange is and how it operates. Remember, it's an IRS-approved process that allows real estate investors to defer taxes on the gains from the sale of a property by reinvesting those gains into a like-kind property. This strategy is a powerful tool for building and preserving generational wealth. We've also walked you through the 5 basic steps to completing a 1031 exchange, from choosing a qualified intermediary to coordinate the exchange, to selling your current property, identifying potential replacements within 45 days, closing on a replacement property within 180 days, and finally, filing the IRS Form 8824. We dove into the process of choosing a replacement property for a 1031 exchange and the guidelines to follow. Remember, properties don't need to be the same type. They can be located anywhere in the U.S. An exchange can include multiple properties, and the replacement property or properties must be of equal or greater value than the one being sold. We also explored the role of a qualified intermediary, an essential player in the 1031 process. We discussed who can serve as a qualified intermediary and the importance of choosing this individual carefully. Looking ahead, it's worth noting that there may be changes to the 1031 exchange on the horizon. As with all tax laws, the rules around 1031 exchanges may evolve over time, so it's crucial to stay informed and consult with a tax professional or a qualified intermediary to ensure you're in compliance and making the most of this wealth building strategy. We hope this deep dive into 1031 exchanges has been enlightening and helps you make informed decisions in your real estate investing journey. Remember, knowledge is power, and in the world of real estate investing, it's the key to building and preserving wealth. If you found this video helpful, don't forget to subscribe to the channel. This is Doc from the Wealth Boardroom signing off.